closer to market time here, so I promised some folks I would, and I was excited about it, honestly, I would talk about crash. I'm calling it crash, CRSH. It's just kind of fitting if it's a inverse bearish stock fund to Tesla. Okay, so as much as I understand this, at times it could confuse the hell out of you because everything's sort of inverse, and then there's one little area that's inverse but it's different. So let me jump into it. Let me go over one basic with you guys, though, so you just understand this. Whoops. Yeah, this is what I want. So as a reminder, and anybody who wants a brush up course on options, I've done one or two that sort of explain options. Now, the synthetic is putting two pieces together and calling it an option. Otherwise, all calls and puts are pretty straightforward. But there's two things you can do, like take a call. Most people think a call is bullish. But if you buy a call, you're betting that that stock's going to go up. You're only risking the call premium, right? And if it doesn't go up, you just lose your premium. You don't lose anything else. If you sell a call, think of it as a covered call, right? So I've got a $10 stock, and I think it might go to 11, but it's likely not to go above that. So I go 3 months out and I sell a $12 call, right? I'm willing to sell the stock at $12, but I'm kind of hoping it doesn't go there. And let's say they give me 30 cents, just making this up, right? So now I sold a call, but I'm not so much bearish as I am just trying to collect the premium. If I truly thought it was going to go to 15 from 10, I wouldn't be selling a 12 call because they're going to give me 30 cents. If it goes to 15, they're going to take it away from me and they're going to give me $12 for it, even if it's 13, 14, 15, right? Once I sell the 12 call, I just gave them the right, and they gave me 30 cents. I gave them the right at any price from 12.01 and up to take it away for $12. So that's referred to as a covered call. I own the stock and I sold the call. But I can sell what's known as a naked call. I can go out and I think this stock, I'm bearish, right? I don't think this thing's ever going to go to 11 or 12 or much more than 10. So I go out 2 or 3 months and I sell a $10 call. I don't own the stock, but I've got cash and I have the ability within my fund to show that I understand options enough that I could create what's referred to in the industry as a naked call. I'm selling a call without owning the stock. So if that stock goes to 11 or 12, right, I've got to buy that back. Right? It's basically a cash settlement. I sold that call. If that stock goes to 20, I owe them $10 a share, right? And if I did one contract, then that's a lot of money, right? So that's why there's exposure when it's referred to as a naked call. You're exposing yourself, right? So you have to be careful, but if you're right, then you just collect the premium, right? And nothing happens to you. That stock goes to 9.5 or 9, it goes to 9.99 or even 10 even. You just kept the premium that you sold, right? So that's why it can be both bullish and bearish, depends on if you buy or sell. So take a put. The normal association with that is you're bearish. So if you buy a put, if a stock's $10 and you think it's going down to 7, but you don't want to try to short the physical stock, so you buy a put and you pay some premium, right? But all of a sudden when that stock goes to $7 and you paid maybe 30 cents for that premium, right? Because trading at 10, and all of a sudden that stock's at 7, that put is worth $3 at a minimum, right? The difference in the price. So you just 10x'd your money, right? 30 cents to $3. But if you're wrong, then you just You bought it, you're only risking the premium, right? If it stays at 10, then it expires worthless. There's no value anymore, right? So you bought it for 30 cents and you lose your 30 cents times however many contracts and shares. So that's just kind of so they can be two different things. But let's jump into crash. I don't want to do a full options thing. So you'll see when I talk about weeklies and synthetics what the bet is. And by the way, Yieldmax didn't give all the data. If you go out and try and see the holdings, they show PayPal's, right? PYPL, the Yieldmax fund covering PayPal. So a little frustrating. I sent a note to them. I'm sure when they get in on Monday, they'll fix it after market today. I could tell by looking at what they did show what a couple of the transactions were. So I'll talk to that, right? So the fund really opened either 5-1 or 5-2. I think it opened on 5-2, so we assume it's $20 before. It closed at $20.08, right? And what's the underlying? Well, the underlying is the same as Tesla. It's just that their performing option strategy is putting a synthetic together and it's flipping the call and the put. Instead of buying the call, they're selling the call. Instead of selling the call, they're buying the put. That part is identical other than it's inverse. What gets a little bit tricky is what they do, what we call the weeklies. They can be a call and a put. And one is short and one is long, whereas all of the long stock ones, the calls are always weekly calls, right? And they just use different strike prices. So that part's going to seem a little strange to you. So we don't have much going on yet. I kind of like the idea of having a bearish. If there's little movement either way, you could make money on both of these technically. The other strategy is, I showed a chart. If you happen to catch my other video, I should have put a link in the description in this one. I'll do that next time. But look at my one that I put out earlier this morning. And that's talking about risk and a lot of different things. And in that example, I talk about why Tesla, people lost a lot of money in the synthetics because it was just chart-wise, once it broke a certain level, it was going down. So people had horrendous losses in their NAV price, right? It had to inverse split and all kinds of things because they were chasing yield in a fund that is a bullish bet. So now with crash, you can go bullish or bearish, and there's some, but my gut tells me, go back and look at how I analyzed that chart. And I think right now they're in the middle. Elon Musk has done some things to sort of stabilize the stock. It started moving back up in the channel. But my gut says the economy's turning down. Consumers don't have the same amount of money. He's already lowered the price. He's talking about new products that are, out till August, September. While I would be bullish on Tesla in a year or two. I think that it's the future of electric cars and automated driving, autonomous driving, lots of things, like a computer on wheels. I think he's brilliant. I think it has a future. Personally, I think on that chart it's got a double bottom. I think there's more probability in 4 months it goes to 100 than it goes to 250, and it's a 180 now. So, but it clearly could bounce, and I'll be watching that chart. So right now, the move's probably bigger up or down than just small, steady little. I mean, it may do that for the next week or so, but I think it's going to break one way or another. But this is an interesting fund. So I'm not, there's not a whole lot of stats to go through here. It collects money the same way, right? Just slightly different. This one, they're selling a put, right? And they're betting it goes down. And then on our weeklies where I mentioned, Tesla, it moved up. Crash went from 2008 down to 2005 on Friday, right? The implied volatility of Tesla is, around 44%, down slightly. Tesla went up, I think, $1, right? What did I show on May? So, yeah, it went from 180.01 to 181.19, roughly a percent up. And in a bearish fund, you want to see it declining, right? You don't want to see it climbing. But you want a slow, steady. You want a massive drop either, the same way you don't in the bullish funds want the synthetic to run right by the weekly, and in this case, what they call a call. So they sell a 175 strike, kind of what we know as weeklies out at 510, right? So they're wanting it to move down between 175 and 180, but go right down here, close to 175, and they'll make money. This call is interesting, right? Because now you have a weekly, unlike in the bullish bet, it's way out. It matches the synthetic dates out on 7/19. It's way out of the money. And they buy at 265, and you could say, why did they do that? Well, it's protection, right? Because if this stock just runs really high, then they have massive exposure selling these puts, right? They got to buy them back for big dollars. And so if it runs to 265 and they've written all these 180s, and by the way, on that synthetic, let me pull it up. This is a synthetic, right? So in this case, these are the calls where they normally buy and sell the put. They sold that call, right? They sold that and collect money on the call, and then they buy the put because they think the put's going to go down, right, and expire worthless. They want Tesla in the synthetic to be under 180. Well, what if Tesla ran to 280, right? So you'd be like, oh, that's $100, right, loss right there if it ran to 280. So what they did was they sold some, by selling the calls, those just expire worthless, or buying the calls, they expire worthless. But selling the puts cost them a lot of money, right? They got to buy those back. So that's one way of getting that protection, is having that, because it's a bearish bent, is having this call. So if it ran to 280, once it gets to 265, that's like the max loss on that put. Now they start making money, right? And they only had to pay like 14 cents, right, out to July 19th. So if somebody told you Tesla was going to go to $400 and you knew it was going to go to $400, you could go out and buy a bunch of calls at 14 cents, and all of a sudden at $400, they're worth 135 above right there, right? 14 cents becomes $135. So, there's strategies. That's a bit of a protection strategy, but nowhere did we ever have weekly calls in the long bullish stock bet more than a week. So we're always going to have some of this weeklies where we sell the put, but where we buy this protective call. So that part is even strange to me. I understand how it works, but it's still strange to see it. So if I go over to my payment tab, not much going on. Here's the synthetic. We picked up some cash. We picked up a little cash in the call. The holdings, they didn't publish the full holdings. So while I know how they have money, I don't really know the share count, right? Normally they started around 125, so I use that number, but later today I'll have the real number there for you. So I'm not going to belabor this. The market's going to start. I got a number of things to do to get ready for that. But I'll get this out. I'll tune this thing up so it's easier to understand for you guys and move forward with it. Again, this is Bruce. This is not I'm not a professional advisor. This is not financial advice. It's for fun and education. See ya. Bye.